Were you a little bit worried about the performance of global markets in this quarter?
Look, we wanted to do three things with global market. It was actually free to contain its size.
Yeah.
We brought it to below 60 billion of RWA. To de-risk, we've de-risked massively. Okay? We've cut inventory by between 40 and 60%. This is why we haven't seen losses in these markets, in global markets. And cut the cost from 6 billion plus to 4.8 billion. And we have delivered on each of those three objectives. The one thing we don't control is revenue. And I'm quite relaxed about that because we don't control it. So what would have worried me during the quarter was if I'd seen signs of poor risk management or cost, lack of control of cost. But on all those three things, the business has delivered.
So you're not planning further measures to boost profitability at global markets?
Well, we did a little bit during Q3. You see, optically, we're down 19%. Actually, we're down 13%, and we're up 6% in equities and down 15% in fixed income. 7 points of that decrease are a restructuring we did in Brazil, in Russia, in a number of our emerging markets to bring the business back to London, and also a restructuring of our US rates business. So that's the last piece of restructuring, which will ensure that we hit the 4.8 billion of cost we said for 2018, and that we have a good basis for
nothing further?
Nothing further, because really we will not have to, as I said, the beauty, what's happened in global markets is that they have been very good at cutting the cost, cutting the risk without destroying the franchise. We're still number one in asset finance in the US. We're still number two in leverage finance. We're still number 4 or 5 in prime, in cash equities in the US and Europe. So we've remained a very, very, very good player. And that's very few banks have managed to do that.
And so you'll hit your target in that unit and overall?
1 year later, I think. And we've said that at Q2, that the 10% return on capital in global market at this point was too ambitious given the market conditions. But we're confident that with this windfall of 250 million next year, we'll get in the highest single digits, which is more than enough because the rest of the business, which is where I'd like to go, is really booming and doing very, very well with very high return on capital, including the IB, where we now, if you look at all the global banks between 2015, third quarter and now, we've grown the most. We've grown 31% in IBCM globally. We're now firmly number 2 in Asia. We are number 1 in Switzerland, uncontested. And we are in Europe, between Europe and America, number 4 or 5, which makes us the 6th largest global bank and way ahead of all the Europeans and 30% bigger than our closest European peer. So that's something that we're really pleased about because it shows that the focus on wealth management has not hurt the investment bank. On the contrary, our investment bank, which is attached to a successful wealth management business, is actually doing better than the other investment banks. And that's for us very comforting because they've been focusing, and Asia played a big role in that, on serving our ultra-high net worth and our wealth management clients.
At your investor day, will you focus on cost efficiency in any of the units?
Cost has been a big part of the story because it's something we can control and where we were not competitive. With that 17 billion will be done. All I've said after that is we will continue to emphasize efficiency, i.e. 2 to 3% improvement every year. And that I'll be very firm on. Once we've made all that effort to get back in shape, now you need to continue exercising to stay in shape. It's not the time to go back to the couch and watch TV. So we have gotten back in shape, and we will stay in shape. Staying in shape means you need to improve efficiency. Nothing spectacular.
But this is all the units, or is there one
globally,
unit?
By 2 or 3%. You know what? Productivity in the world increases by 2 or 3% every year. So any company or entity that's not doing that is falling behind. You may not feel it, but the world moves forward. The world is not waiting for you. So now that we've gotten back to the level of efficiency we should have, I'm very firm that we need to continue on a healthy exercise regime and continue produce some efficiency every year, but nothing like what we've done in the last 3 years, which was massive, 4.2 billion of savings.
How do you see the markets developing overall? And therefore appetite actually for your clients. You said that in a market round they're a little bit more shy of putting money in.
Look, the beauty of our model is we follow our clients and we can do different things at different points in time. If you look into our results, you will see that the kind of very stable revenue sources, net interest income, fee income have been going up nicely, and transaction revenue suffered in the third quarter because of the general uncertainty, clients have been a bit sitting on the sideline and not transacting. But that never lasts forever. These are transitory phases. After
when do you see that changing? When do they come back in?
I'm not going to put a date on it, but in the kind of next 6 to 12 months things will change because a lot of uncertainty will disappear. The nature of uncertainty is somehow at some point to disappear. But we were at a point of maximum uncertainty with all the events this summer. I've always said, I think to you many times, that the exit of QE would not be without issues. It's a sea change for markets, and people have to adjust to a new normal. That means a lot of anticipations have to be changed. But fundamentally, the economy is strong. That remains globally. I think the IMF reviews its forecast downwards a little bit, but the economy globally remains strong. That's enormous. Everybody tends to forget that, but that's enormous. I've said there's a disconnect between the strength of the economy and the mood of the markets, because none of us is used to such a long cycle.